Now, the administrators of scandal-hit spread betting operator World Spreads said today that there are several parties interested in buying parts of the company, but there would be no sale of the business as a whole. Accountancy firm KPMG, which is in the process of winding up the company, says that some of its software and data centre assets could be sold. City of London police have been asked to investigate an alleged fraud at World Spreads after a £13 million hole was found in its accounts, putting about 15,000 customers at risk of losing almost half their money. Now, spread betting operators, unlike traditional bookmakers, which offer a limited range of options, allow for a much wider range of possible outcomes. For this reason, there is the potential for big winnings and also heavy losses. Most spread operators take wagers on activities including sports and financial, currency and commodity markets. Take the FTSE 100 as an example. Let's say this morning I thought that the index would shoot up today and as a result placed a bet of £10 a point. Had I been right and the market had ended the day 100 points higher, I would have won £1,000 tax-free, that's 100 times £10. But in fact, the FTSE 100 dropped by 69 points, so I would have had to pay out £690, 69 times £10. Well, joining me in the studio is John Frenkel, principal of the Forensic Chartered Accountants Frenkels. Nice to see you. The obvious question, where's the money gone?
Well, it's difficult to say without having looked at it and examined it, but it's either gone to support trading or might even have been taken by the people that had access to the money.
So, what you're saying is we don't know whether this money was lost through trading incompetence, just being bad at business, or there has been foul play.
Yes, but either way, the money should not have been accessed because this was client money that was supposed to be kept in a segregated account, which wasn't to be used for the purposes of trading, but just to be kept there to cover the client's positions.
Let's be clear, £13 million, a big sum of money, but this is not an enormous company, is it? This is not a company with billions. £13 million lost out of World Spreads is a hefty chunk.
It's huge. Its balance sheet at the last year end showed that it had a net worth of £8 million, but it had clients' money of about £23 million. So disproportionately, it was carrying a lot of clients' monies.
So what about the Financial Services Authority? This is the regulator. It's supposed to be monitoring this kind of thing, isn't it? And what about the auditor? I think it's Ernst & Young, isn't it? Aren't they supposed to check the books?
Well, they are, and they've signed off that they have done. And now, why there's the differences is difficult to know without having examined it. And there's also, one doesn't know at this stage, when the regulators last went in. What I do think should happen is that the regulators should be able to go in and check the books much more regularly. I think having FSA approval is a real privilege, and it's given away a bit too cheaply, because at the end of the day, the people who had the clients who had their money will be covered to a large extent under the Financial Services Compensation Scheme, but it'll be the taxpayer that has to foot the bill on this.
Is that right? I was about to say, I mean, you're an expert in this, John. This is what you do for a living. In your experience, what's the chance of all this money being recovered?
Well, the money there's a good chance for the people who had the client money will be able to get their money back, because provided they were under £50,000, they should be covered under the Financial Services Compensation Scheme. So they probably won't complain too much. Shareholders are taking risk in that type of business anyway, and if it was through bad trading, well, they were going to lose their money anyway.
And they're wiped out, aren't they?
They're wiped out anyway. But it's the taxpayer that ultimately has got to foot this. Whereas I think that if it had been more, if the companies like this who have the benefit of the regulation had to pay for much more regular monitoring and the privilege of that, it could be much more better controlled.
Now, the chief executive, Conor Foley, he quit last Wednesday to pursue other interests, in inverted commas. 4 days later, the company collapses. Today, he's put out a statement through the Irish media saying that it was all a shock to him. He's terribly surprised. Are we right to be incredulous?
Absolutely, absolutely. He actually signed off on the accounts himself last year to say that he's complied with his obligations as a director, which include taking reasonable steps to make sure that fraud hasn't been taken place and the company's balance sheet is showing a true and fair view.
Yes, when CEOs disappear like this, in inverted commas, suddenly to pursue other interests,
Well,
it's normally the sign of worse things to come, isn't it?
Well, one thing you learn in this business is that you don't believe in coincidences. When things happen like that, it's very difficult. If he didn't know, he certainly should have known. It was his responsibility to know.
Exactly. I think it was Hercule Poirot who said 3 coincidences are a clue, and we certainly had
Yes.
3 here. What about the lessons to be learned here for gamblers, if I can put it that way, clients, investors in these companies, and regulators? What should we learn?
Well, I think gamblers taking the chance, but I think that they probably, by and large, will be protected because they were putting their money into a company which had the FSA regulation, and provided anybody that puts that in makes sure that they are within the limits that are covered by the compensation scheme, then they probably wouldn't have anything to worry about. I think that the regulator, rather than saying, I saw a quote this morning that from an unknown source at the FSA saying we just don't have the resources to monitor small companies, but we do concentrate on the big ones. But to me, it could
Well,
be
that's a disgrace, isn't it? Because if that's the case, they should come out and say that beforehand, and then customers and users will be aware of the situation and won't assume that they're being covered.
Absolutely, and equally, they should be. This should be capable of self-funding because the companies should have to pay for it.
Absolutely right.
And if they haven't got the resources, there'll be plenty of accountants and will be more than happy to treat this to subcontract it out to monitor this.
All right, John Frenkel, many thanks for coming in.